Yeah, look, I think in terms of the macro, there's two or three different aspects of macro that we look at. Firstly, what's happening with consumer. Second, what's happening with the industrial and production and manufacture side. And thirdly, what's happening with services side. Looking at these three things gives us a whole perspective of what we think is happening in the economy. If you listen to most of the companies from the industrial side, what they're telling you right now is that they're seeing a slight slowdown in terms of activity, but they're not seeing a dramatic slowdown. They don't see what they think is a recession-style slowdown. What they're seeing is a standard, okay, we've gone through a period of growth in the US, and people are just starting to reassess where we're at, where we're going to go. Europe is picking up a little bit better, but it's been coming from a bottom, so that growth is now tapering off to becoming more normalized. Where we are seeing slowdown is potentially in Asia, primarily in China, but that's nothing new. Everyone knew about that, and everyone's been seeing that for the last 18 months. On the consumer side of things, what we're hearing is a completely different story. In the US, all the banks are telling you, Visa, MasterCard, all their results basically tell us that consumers are spending, and they're actually increasing the rate at which they're spending. And one of the reasons for that is the fact that oil prices are down, and they're slowly starting to see that into their pocket. In the first phase, when oil prices went down 6 months ago, they started saving that money and paying down debt. Now they're starting to upspend. And there was an interesting result from, I can't remember that, Kimco, I think it was a shopping retail trust. And they were saying an interesting takeaway was during 2008, 2012, when the US economy started taking a hit in Europe and people was tightening their budgets, people would spend on the lower quality merchandise, lower quality food items. The example they gave was, they went from steak to chicken because chicken was cheaper. Now what you're seeing is the opposite happening. People are going from chicken to steak. Similarly, as people are spending more. So from that perspective, that's improving. And look at the services side, that picks up when consumer picks up. So in our perspective, the macro is telling us that there is not a broad-based slowdown, but there's not an acceleration in growth either. So we're looking at a 2 steps forward, 1 step back side of an economy. Consumer is the biggest part of most of the developed economies. For example, in the US, consumer is more than 70% of the economy. So if the consumer is going strong, if consumer stays strong, then there's a chance of recession decreases, and they can push the economy through a period of inventory or business cycle slowdown. So that's why the consumer is important. Same in Australia, same in Europe. So from those three, where consumer is smaller is China, where they're still transitioning from a manufacturing and an infrastructure-led economy to a consumer-led economy. And so that's why the slowdown in the industrial there is having a bigger impact. In the Australian market, what we're seeing right now is that there is the slowdown in the Australian market is real. We are seeing impact from China coming through Australia, but it's not a dramatic slowdown. And the slowdown is primarily on the export side, on the mining and resources and oil and gas. And that's been happening for the last 2 years. So there is no increasing pressure on the Australian economy. It's stabilising, and in our view, it's probably going to be stay on neutral gear for the next 2 to 3 months, next 12 months. And it doesn't matter what the RBA does in terms of the cash rate, because what's happening with the consumer, what's happening with oil prices is probably a bigger factor for the Australian economy.